Good morning, everyone. Welcome to Conversations with the Fed, Inflation 101. My name is Carmiana Matson. I am the Assistant Vice President of Regional Outreach and Public Programs at the Minneapolis Fed. I'm joined today by Joe Mahon and Terry Fitzgerald, who will be our speakers. Before I turn it over to them, however, a little bit of housekeeping. We will have some time at the end of Joe and Terry's presentation for questions from the audience. So if you do have a question, you can pose it via the chat box on Zoom, and I will pose those questions then verbally to Terry and Joe at the end of the presentation. Also, when we are finished with the presentation, we would love to get your feedback on this event and other questions that you may have about inflation. So there will be a survey that pops up in your Zoom window as you close the webinar today. We'd love it if you take a few minutes to fill that out. And with that, I'm going to go ahead and turn it over to Joe. He'll be our first speaker for today. Thanks for joining us.
Thanks, Carmi, and thank you to everybody in the audience for joining us today to talk about a very important topic to all of us at the Fed. So Terry and I today are going to be talking about inflation, the current inflation we're seeing, and what the Fed is doing about it. Before I get started, just kind of a quick disclaimer that Terry and I might express some views. Those are just our views and not necessarily those of the Minneapolis Fed or the Federal Reserve System. So what we'll be talking about today, I'm going to start by giving you a little bit of background on what inflation is, a kind of brief historical picture of American inflation. I'm going to talk a little bit about how inflation is measured, what our indicators of inflation are, and what's been happening recently before I turn it over to Terry, who's going to be talking about the Fed's response, what our policy tools are that we can use to fight inflation, and what we've been doing recently. A little bit of a historical overview to start with. So I have here the consumer price index going back to 1800. I'll get into a little bit more detail about what the CPI actually is later. Just for now, take this as basically the price level, or a measure of kind of average prices, or more importantly, cost of living. So people tend to think about inflation as rising prices, and that is how we experience inflation. But ultimately, to get a real sense of what inflation is, I want you to actually think about this picture being flipped or inverted, and think about what a dollar is worth. So if you go to our website, we have this great tool. It's an inflation calculator, and we call it "What's a Dollar Worth?" And you can use it to compare any 2 years going back to 1913, when the modern CPI started, and see what a dollar now would have bought then, and vice versa, or any other amount of money. It makes a quick conversion for you. And I'd encourage you to take a look at that and some of the background. And we have these CPI estimates going back to 1800. I mentioned that the modern CPI started in 1913. So the estimates prior to 1800 are cobbled together from various historical price series. So a couple points I want to make about this if you take a look at this. If you compare the very beginning of this time period going back to 1800, and I'll just point you to 1933 here. The very little, comparing those two endpoints, very little change in the value of a dollar overall price level. Why is 1933 important? Well, in 1933, President Roosevelt took the United States off of the gold standard domestically, signed an executive order in April of that year. And since then, we've seen more steady and rising inflation over that period. So really kind of the value of a commodity standard relative to a fiat money standard is that over long periods of time, money tends to hold its value. What this doesn't show by looking at this long view, though, is what happens over the shorter run during this period. So I've compared just here this CPI series, kind of the average price level, with the percent change year over year. And what you can see is that in this earlier period, where there's not much movement from one end to the other, it masks a lot of movement from year to year. There's a lot of years where prices jump a lot, and a lot of years actually where they go down, where you have what we call deflation. I'm not going to talk about deflation this morning and why that's a bad thing. Maybe that can come up in the Q&A. I think folks are more interested in inflation. But just to call your attention to a couple relevant historical periods here. So you can see kind of the last period of really high inflation prior to what we're seeing right now is this period in the late 70s. early 80s, that kind of great inflation period that was followed by what we in the Fed refer to as the Volcker disinflation, and the following period from about 1980 up until the global financial crisis. That's often referred to as the Great Moderation, a period of low and stable inflation. And that's been the case until just recently. So getting into what's been happening recently, here's a shorter view of the CPI, the Consumer Price Index. I'll tell you a little bit more about what the Consumer Price Index actually is. So this is one of several measures that we have that we can look at to tell us what inflation is doing, how the value of a dollar is changing. And this is released by the Bureau of Labor Statistics as part of the Department of Labor. They originally started publishing this series, as I mentioned earlier, back in 1913, in part both to track inflation and to serve as a tool for employers and unions to think about negotiating cost of living increases and some things like that. So the CPI is an attempt to look at a really broad measure of a really broad range of prices in the economy and kind of summarize it in one quick number. So the Bureau of Labor Statistics employs a lot of statisticians. And they actually go out. They take these data from 75 different urban areas around the country at any given time, any given month when they collect these numbers, and they actually go out to stores and retailers. They do they look at some online prices as well, but they go to 23,000 different retail and service establishments, gather prices on 80,000 items. They also, importantly, because it's a very important part of a family's budget, they also track the cost of housing, and so they survey about 50,000 different landlords and tenants to get measures of rents as well, and they summarize all this information in what we call an index number. And the way they do that is you can think of it as just being an average, but it's a weighted average. So families spend a lot more on some items than on others. You might spend a lot more on clothing, for example, than you do on food. Actually, families tend to spend more on food than clothing, but each of these items in their index receives a weight. So they kind of weight them by their relative importance to get this one overall number. And I have it plotted two different ways here, what we call headline and core. So that's headline is the all items index. So this is everything in the Consumer Price Index, and including food and energy. What we call core in that gold series here is stripping out food and energy prices. And the reason to do that is not because they're not important. In fact, we care a lot more about headline inflation. It's just that food and energy prices tend to be a little bit more volatile. So they give you kind of a noisier signal of what's happening with prices. They might provide a better forward-looking indicator of price growth, but the Fed cares about headline inflation, and as I'll explain in a moment, that's what our target is. But either way you look at it right now, you can see that inflation has increased and is a lot higher than we want it to be right now. So our most recent reading that we have here at the end of the chart is for February of 2020. The all items index headline inflation was up 7.9% year over year. Core, stripping out food and energy, was up 6.4%. So a lot higher than we want it to be. And that's been the case since about the middle of 2021, as you can see here. Prior to that period, inflation was pretty low and stable going back about 10 years. So I have it going back to 2012. What's special about 2012? Well, around then was when the Fed explicitly declared that we had a medium run inflation target of 2%. And as you can see here, I've put that target on this chart. I'm showing you here actually a slightly different indicator of inflation than CPI. This is what we call Personal Consumption Expenditures Index, or PCE. This comes from the Bureau of Economic Analysis. They release this on a monthly basis that they use for inflation weighting their monthly estimates of income and outlays. And that was actually just released this morning. So we got a new reading for February this morning. Again, much higher than we want it to be, a little bit lower than what we are getting, the readings we're getting from the CPI, and that tends to be true over time. This morning's release showed headline inflation rate year over year of 6.4% in the PCE index and 5.4% in stripping out food and energy in that core measure. Now, just to get into a little bit of detail about what this measure is, how it differs from the CPI, it does tend to be a little bit lower over time. This estimate comes from a slightly different, it comes from both different data. So the CPI data comes from surveying consumers primarily. PCE data comes from surveying businesses. One other important difference, and one reason it's kind of the Fed's preferred measure, is this is a measure for the whole country, whereas the CPI that I just showed you before is a measure for urban consumers. So it comes from large and medium-sized cities, whereas this measure includes the whole country, includes rural areas as well. It also includes some expenditures that aren't covered in the CPI, and in particular expenditures that are not out-of-pocket costs. So if you think about health insurance, employer benefits, and some things like that. Most importantly is takes into account consumer behavior a little bit more. So if you think about the fact that when peanut butter gets more expensive, you tend to purchase less peanut butter, but you also tend to purchase less jelly. So those are the kind of substitution effects, and the way that they do the weighting and the formula that they use for the PCE tries to take those into account. So it's a broader measure and it's a more behavioral measure. And so that's why the Fed tends to rely on this measure. But as I said, either way you slice it, inflation is a lot higher than our 2% target. And if you look prior to about mid-2021, for the prior 10 years after we had declared this 2% target, we were running persistently below that target for that period. And we didn't view that as a great thing either, because in the monetary policy world, reputation and consistency is very important. And when we declare a target, we want to hit it. But now we're well above target. And I'm going to talk a little bit about why that's the case before I turn it over to Terry. So breaking down some of the prices in the CPI and where the movement has been recently. So I mentioned earlier, the CPI is calculated by looking at a lot of different prices and where they're moving, and they're weighted they're given different weights. And you can see here, looking at the most recent CPI, the things that have increased the most year over year, and most strikingly, of course, used cars and trucks. If anybody is in the audience has been in the position of purchasing a vehicle recently, you know that new cars take a long time to get. They've gotten more expensive. And that's due to some of the difficulties that we've had in the global supply chain recently, in particular, the availability of semiconductors and microchips that are put into cars. And so there's been much longer lead times to deliver new vehicles. And as such, consumers have switched to purchasing used cars as a substitute for new cars. And that's been reflected in huge increases in the price of in-cars. So very strong vehicle demand right now. And so over the last year, we've seen really extraordinary growth in vehicle prices overall, and particularly in used cars. Gasoline prices, I don't need to tell anyone in the audience, are up quite a bit, as are overall energy prices. A gasoline in this index is a subcomponent of energy, but both of those are up significantly. Gasoline is up more than just under 40%. Energy is up more than a quarter year over year. And you can see how these compare to the overall change in the index. So one of the important things I want you to take away from this slide is that index number, while it's informative and it gives us kind of a quick read on what inflation is, masks a lot of movement that's going on underneath the surface. Prices are always for any given good or service, they're going up and down for various reasons that don't necessarily have to do with inflation. Just because the price of gasoline is up, that doesn't necessarily mean that we're experiencing inflation. It might be because there was a supply shock, as we're seeing right now with the crisis in Europe. And so it's worthwhile to look at a little bit more detail on where prices are moving, and kind of the pattern that we're seeing in consumption and some of the fundamentals that are underlying the acceleration in inflation that we've seen recently. So to get into that story a little bit, I've plotted here what people are buying nationwide. So this is personal consumption expenditures data. I've indexed it to the beginning of the most recent recession, February 2020, at the beginning of the pandemic. And what you can see here is at the very beginning of the pandemic, when the economy was going into shutdown mode, we were seeing record numbers of job losses every month. We saw a huge decline in consumption. However, very quick rebound in consumption of goods fairly quickly after the beginning of the pandemic. And this came as a surprise to a lot of observers. People weren't exactly sure what was going to happen to the economy, but a lot of people were sitting around their houses and looking at working from home and looking at their deck outside or their kitchen and thinking about remodeling. So we started to see right away a lot of purchases of big ticket household items, appliances. We call these durable goods, things that last longer than a year. And if I were to show you this series over a much longer period of time, you would really see just slow growth over time in goods purchases, and in particular durable goods purchases. But if you look right now at the beginning of this year, durable goods purchases were up more than 30% relative to a year earlier. And so the pandemic kind of caused a substitution in the way people spend their money. So early on in the pandemic, because we weren't able to travel as much, to go to restaurants, to go to the salon, purchases of services went way down along with other consumption, and they recovered much more slowly. Meanwhile, goods purchases rebounded very rapidly and have remained very high. So you can see this reflected in the ratio of the price of goods to services. So I have here just the PCE index for durable goods relative to the PCE index for services. Now, a couple important things to note here. Goods prices tend to be pretty stable over time. They don't go up a lot on average. Of course, individual goods might go up or down, but on average over time, goods prices tend to be pretty stable because of technology. And relative to services, again, if I were to show you this for a much longer period of time, you would see a long-term decline. Goods get cheaper relative to services because, of course, services are more labor intensive. You need people to deliver services typically, and people don't get cheaper over time. And so so over time, the long-term pattern here is that goods get cheaper relative to services, and we've seen this invert since the beginning of the pandemic. And because of the way that we measure inflation by looking at a broad array of prices, big growth in the price of goods has been reflected in higher inflation readings. So that's kind of a story going back to about a year ago that we were looking at the data and seeing play out. The substitution effect that the pandemic disruptions that the pandemic was having, the supply chain disruptions that were going on, were leading to bigger increases in goods prices. And the other thing that was going on a year ago was that we were seeing finally a rebound in services. So I'm going to, in the next few charts here, I'm going to kind of go through a sort of a blow-by-blow account of what we were seeing in the data over the last year. So I'm showing you here the net contributions to CPI inflation, and this is core CPI. So I'm ignoring food and energy, again, not because it's not important, just because we want to see we get a clearer picture of what's going on. I'll show you some data with food and energy in a second. But if you look at the beginning of 2021 last year, we were seeing higher inflation readings up into, so this chart goes through June of 2021. You can see the 3 months, April, May, and June of last year. We saw a big increase in CPI related to vehicles. So that was that period where we really saw car prices pop, particularly used vehicles, again, because of these supply chain disruptions. And some of this was going on prior, but it really accelerated at that period. So we could explain a lot of the jump that was happening in inflation at that time as something that was kind of specific to the vehicle market. The other thing that was going on at that time was a rebound effect in services. So if you go back a little further in this chart to in time to early 2020, when the economy was going into shutdown, people were curtailing their purchases of services. We saw that reflected in a decline on average in the prices of services. So this chart here shows you what we're calling pandemic affected services. That's things like airlines and hotels that were really heavily affected by the pandemic. And you can see that on net, they were contributing negatively to inflation because those prices were going down. So fast forward to early 2021, after we got through that winter wave of the pandemic, where we kind of went back into shutdown mode in late 2020, early 2021, we started to see this rebound in services. And so during this period, we knew that some of the inflation readings we were getting was just due to a rebound effect. That inflation, we actually saw disinflation earlier in the pandemic. So a year later, when you look at year over year terms, part of the increase in inflation was due to that, and part of it was due to increases in purchases of services and things that were particular to the vehicle market. Over the next few months, so going through September of 2021, this story looks pretty good. You see that some of these, and I should have pointed out at the outset here, these are just so far prior to these charts, I've been showing you the year over year change in inflation. These are just the month to month changes. So you can see that in the months of April, May, and June, there are big increases in vehicle prices. If you were to show the year over year prices, as you saw in the earlier chart, where you saw the year over year change in vehicles, those are going to be persistent because they go up. But just on a month over month basis, we started seeing fewer of these shocks to vehicles. And as we got into kind of the recovery from the pandemic, some of the effects of the rebound in services spending started to tamper down. So this story started to look pretty good until you get into late 2021, when we start to see again more growth in vehicle prices. But more importantly, those columns at the base there, those portions of the column that I'm just calling other goods. So that's everything else in the index that's not pandemic affected services or vehicles. Those tended to be relatively low and consistent over this period. But in late 2021, we started to see the price pressure spread to other parts, other components of the price index as well, other areas of the economy that weren't necessarily just related to these disruptions in the vehicle market and to pandemic affected services. So that's when it became clear that inflation that we were seeing was not just transitory, perhaps as the term was used about a year ago, that these increases in inflation maybe had a little bit more legs than we were expecting earlier on in 2021. So just to kind of end my portion of this talk on a relatively positive note before I hand it over to my colleague Terry, I'm just going to show you components of overall CPI like I was just doing. So similar data, I'm showing you the net percentage point contribution over time. Now I'm including food and energy as well. One thing I want to point out, if you look at this series, it kind of shows the value of core inflation stripping out energy as an indicator, not because it's unimportant. Our target is for headline inflation, but you see energy prices sometimes go down as well. And they're just a little bit more volatile. So recently, of course, they've been going up, as have goods prices. So that's the other thing I want to draw your attention to. If you go back to the earlier period of this chart, going back to the earlier years of the last decade, up until very recently, there's very little movement in goods prices. So goods prices on a month-by-month basis, on average, tend not to go up. In fact, they often go down, and again, that's due to technological reasons. But that's not the case over the last year. We've seen big increases in goods prices, big increases in energy prices too, and of course you can see that growth in services at the base of these charts as well. So, sort of to close on a little bit more optimistic note before I hand it over to Terry, we know that over time goods prices tend to be flat or to go down. Energy prices are a little bit more volatile. So there's some reason to hope, looking at this picture, that we'll see kind of a return to the historical norm and see those prices tend to revert to what they usually do. But as I started out by saying, any way you measure it, inflation, as we're seeing it, is very high, higher than we want it to be right now. And so that's a good place for me to stop and turn it over to my colleague Terry, who's going to talk about the Fed's response and what we can do about inflation. So while Terry gets his slides up on the screen here, I'll just introduce briefly. Terry Fitzgerald is our vice president at the Minneapolis Fed in our research department. He's in charge of the bank's economic analysis and forecasting unit. So he's in a great position to tell us more about the Fed's response to inflation.
Okay, thanks a lot, Joe. Before I get started, I just want to repeat the disclaimer that the views I'm about to express are my own and not necessarily those of the Minneapolis Fed or the Federal Reserve System. So before I get started on the response, I just want to take a quick step back and remind you that the Federal Reserve was created by the US Congress back in 1913, and the objectives of the Fed are determined by Congress. So in 1977, they assigned the Fed what's called the dual mandate. You see the language there: promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. Typically, that's referred to as a dual mandate with maximum employment and price stability. So that's our assigned task from Congress. Maximum employment is a difficult thing to measure, but it's clear in the current environment that labor markets are very strong and that the spirit of that mandate is being satisfied. Inflation, on the other hand, is much too high, well above our long-run goals, well above anyone's comfort level. So we're acutely aware that high inflation is imposing significant hardships. It's raising the cost of food, housing, transportation, gas, energy, and a bunch of essentials, all those things that we need to use every day to function. And those hardships are especially trying for those with low income. So we're well aware that this high inflation environment is a difficult one for most of all of us. And the FOMC and Chair Powell are committed to restoring price stability while preserving a strong labor market. So I want to talk a little bit about how the Fed's doing that. So what we have is two main tools for achieving the dual mandate. One is a policy interest rate, an overnight rate, lending rate known as the federal funds rate. And the second is the Fed balance sheet. These tools allow the Fed to influence the strength of the economy by influencing interest rates. So the Fed used both of these tools to soften the devastating economic blow created by COVID in 2020, when over 22 million people lost employment. So let me just show you a chart. This is the federal funds rate. You can see the huge drop there. The recession is shaded. You see the federal funds rate went almost immediately to zero. We took it almost immediately zero when the shock hit, and that helped mitigate some of the damage. So since then, labor markets have vigorously recovered, as Joe just discussed, and inflation has risen much higher and more persistently than the Fed and private forecasters expected last year. And as a result, the Fed has pivoted to remove the accommodation it provided and has committed to do whatever it takes to lower inflation back to the 2% target while maintaining strong labor markets. So what are we doing? Well, the first thing that's happened is toward the end of last year, the FOMC started signaling that it would start removing accommodation. It announced it was tapering its asset purchases. I'm going to show you that shortly. And it signaled that it would start increasing its policy rate in 2022. Since then, what we've seen is the FOMC increased the policy rate for the first time in March. That's the first increase since the end of the pandemic. And you see that on the chart, the slight intake. So that doesn't look like much. But what's more important and much more powerful for policy is the guidance the FOMC provides to markets about future policy changes, including rate changes. So this is referred to as forward guidance. In recent communications, the FOMC and Chair Powell have clearly and forcefully signaled that ongoing rate increases should be expected in 2022 and 2023. Expectations of future rates are critical to financial markets, and by clearly announcing the FOMC's intention for further rate increases, policy tightens much more than just the current rate increase you see in this chart. How do we see that in the data? So first, let me show you something called the Fed Funds Futures. So I've added this dashed gold line shows you what markets expect the Fed funds rate to be over the course of the next 2 years. And what you see is that markets are currently expecting roughly 200 additional basis points, 2 percentage points of additional rate increases this year. So a dramatic increase in the policy rate this year. That 200 basis points suggests more than 25 basis points at some upcoming meetings. So that's what markets are expecting. That's what's being built into the economy. You can notice the pace of that increase on the gold lines is much more rapid than the gradual pace of tightening that the Fed pursued in 2016 and 2018. So how does that expected path of the rates influence broader interest rates? So let me just show you these treasury rates as an example. So treasury rates have moved up a lot in the last 6 months. They've moved up about 150 basis points. That's in response to expectations of Fed policy. Loan rates are tied with these treasury rates. So you'll see interest rates coming up. We're seeing longer rates also increasing. So a good example of that is mortgage rates. So those have come up since December. You're seeing those come up 150 basis points in the last 6 months. So that's an example of why the importance of forward guidance. Even though we've only had one increase, markets are looking ahead. They see that the Fed is now serious about raising rates. It's signaled it's going to raise rates in its pursuit of that stable prices, and the markets are responding to these rate increases, and you see that in these interest rates. So I just want to say a couple of things about the balance sheet, what we're doing with the balance sheet. So let me briefly mention that our other tool is the Fed balance sheet. During the pandemic, the FOMC not only lowered the federal funds rate, but added accommodation by increasing the size of the balance sheet. So you see the sharp tick up there in 2020. So this increase put downward pressure on long-term interest rates and promoted smooth market functioning. So since about last November, the Fed has been tapering its asset purchases. So we started a pivot. We started increasing the balance sheet at a slower and slower rate, and we stopped additional purchases altogether in March when we increased the federal funds rate. So at its March meeting, the FOMC raised rates. It also signaled that it expects to begin to reduce the size of the balance sheet at a coming meeting. So this forward guidance further removes accommodation by putting upward pressure on longer rates. So Chair Powell, the FOMC, and the Federal Reserve are committed to restoring price stability while preserving a strong labor market. The recent actions and forward guidance by the FOMC demonstrates that commitment, and financial markets and observers understand the seriousness of that commitment. Market and professional forecasters have remained steadfast in their belief that inflation will return to 2%. That's a powerful credibility message for the Fed. They know that we're serious about returning. The Fed's serious about returning to 2%, and markets are building that into their expectations. So here I'm showing you a view of long-term inflation expectations. So if I show you the next year or two, markets and professionals are expecting higher inflation in 2022, coming down a little bit in 2023. Here I'm showing you longer-term inflation expectations. And what they show you is that the gold line shows you professional forecasters think we're returning to 2%, and markets, people with a financial stake in the game that trade financial assets based on future inflation. Also, you see that blue line that's moved up from the lows, but relative to the last 15 years, it's stable. It's right in the range consistent with 2% inflation. So that reflects the market's belief in the Fed's credibility that we are going to return to 2%. That's what we're committed to do. So I think I'll just close on that. That's what the Fed's responding. We're committed to getting back to price stability. We're unhappy with where inflation is now. And let me just close by saying thank you and turn it over back to Carmi.
Thanks, everyone, for joining us today. We are going to move to questions for our presenters. We'll be taking questions via the chat box on Zoom. And if you are interested in continuing this conversation with us and learning more about inflation, and in particular, the unequal impacts it has on different demographics, you can join us for our next virtual event, which is Tuesday, April 5th from 9 to 11 a.m. Central Time. That's going to feature Fed Governor Lael Brainerd as the keynote speaker, along with some prominent economists. And I'll be dropping some registration information for that event in the chat box. So with that, we will turn it over to a little bit of Q&A. And we've had a number of questions come in through the chat box. You're welcome to still submit them. We won't be able to get to everyone today, but I've seen a few themes pop up in the chat box. So Joe, can we start with you? You did briefly mention deflation. And so we had some questions in the chat box about why is deflation a bad thing? And essentially, why do we want some level of inflation?
Yeah, so a good question there. I did allude to that, and maybe Terry has some thoughts on this as well. But the short answer is is that so I showed you that chart of the 19th century in the United States, where we had kind of much more volatile prices. Prices were tied. The value of our currency was tied to gold and silver, and those tend to move around a lot as well. And they're subject to shocks just like any other commodity. One thing that happens during periods of deflation, so it's often said that inflation is bad for lenders and good for borrowers, because if you take out a loan, the value of the money that you're paying it back with goes down a little. That means the real value of what you're paying back has gone down. So if you're getting a loan paid back to you, that's not a good thing. If you're paying back a loan, that's a good thing. Low stable rate of inflation tends to get kind of priced into interest rates that banks charge. So folks expect that. When you have a deflationary shock, that means that those who owe money are going to be paying back loans in more expensive dollars in higher valued currency, and that tends to lead to a strategic decision to maybe not pay back that loan. If it now becomes less favorable to repay a loan, folks are more likely to default on loans. So deflationary periods tend to coincide for a variety of reasons with financial panics, with banking crises. And we know from the 19th century that there were a number of severe banking crises that were preceded by long depressions or recessions that followed those. The other thing that happens with deflation is if you think about whether your decision to buy something like a washing machine or a car, an expensive item, and whether you want to do that now versus wait till next year. If you know that the money that you have just sitting in the bank or maybe under your mattress right now is going to be worth more next year, maybe it makes sense to kind of hold off on big ticket purchases because prices are going down. That washing machine is going to be cheaper. Your money is going to appreciate, right? Well, if everybody starts thinking in those terms, that tends to have a depressing effect on consumption. And then that in turn has a depressing effect on prices and kind of reinforces that deflationary environment. And that's a sort of a deflationary spiral. And that's actually part of what we saw happen during the Great Depression. At least that's kind of one of the stories about the Great Depression. So so for a variety of reasons, deflation can be bad. And that gets into why the 2% target. 2% really, part of the reason for that is it just a cushion between a little bit of cushion above zero. Because people, we know from historical experience, we've learned to live with a sort of a low, stable rate of inflation over time, whereas deflation can be pretty bad. So if we can kind of avoid a deflationary environment, that's part of the reason for the 2% target. I don't know if you have thoughts on that, Terry.
That's good. I think just in general, it's just that the economy operates better with a small amount of predictable inflation. It allows monetary policy to work a little bit better. We have some room to help smooth out some of the volatility in the economy. So if it's low and predictable, that allows us to help the economy along when we need to during tough times. It also helps labor markets and wages adjust more efficiently. So the economy just performs a little bit better. Sometimes you'll hear people, Japan's had zero inflation for 25 years, and people point to Japan as that low inflation contributing to suboptimal performance. Just the economy just is going to work a little better with low, predictable inflation.
Thank you. Another question for Joe. There was a little bit of pushback in the chat box about the idea of core inflation and that stripping out of energy, stripping out of food, stripping out of the very things that are so important to so many consumers. And why don't we have a measure that really captures every aspect of what it costs to be a consumer these days?
Well, it does include. So I showed you, the only reason I even showed core is just because you get kind of a more steady read over time. Like I said, that the overall rate of inflation is a little bit more volatile because food and energy prices tend to be more volatile. We care. The reason we have that inflation target, the reason that we have the dual mandate that Congress gave us is because of the concern about the cost of living. So people don't have the luxury of just ignoring food and energy prices. And so we care about those things as well. And that's why our target is focused on the overall all items rate of inflation, including food and energy prices. So it's not that the CPI ignores those things. In fact, it does include food and energy. And they actually have a pretty strong weight in the index as well. I mentioned the weighting. People spend a lot of their budget. Households spend a lot of their budgets on food and energy, and so those things matter. So CPI does include those. One other thing that I'll mention that I didn't really get into. One thing that people will point out about price indexes is that that the things that we're measuring the prices of tend to change over time. Not just the price, but what it is that we're measuring. So when I was a kid, a box of cereal was £1. Now you go to the grocery store, a typical box of cereal is 11 ounces, right? Because the people who make cereal decided instead of raising the price that we're going to charge for cereal, we're just going to put a little less cereal in the box, right? Well, the BLS does actually try and account for that, the Bureau of Labor Statistics, in calculating the price index. They make those adjustments. They're not just looking at what a box of cereal costs. They're looking at they're looking at the quantity of cereal. And then the other thing, of course, that happens over time is things get better, right? Certainly a cell phone now does a lot more than a cell phone did 10 years ago, a lot more than a cell phone did 20 years ago. So there's quality adjustments. Those can be hard to capture, but they make adjustments to the index to try and account for quality adjustments in goods. Anybody interested in this, the Bureau of Labor Statistics on their website, bls.gov, has a lot of great information, a lot of it non-technical about how they do these things. I'd encourage you to take a look at those. And if you're into math, they have technical information there about how they calculate the indices and how the weighting works and all that stuff too.
Thanks, Joe. Let's turn it over to Terry for this next question. Terry, what took us so long? Why? We talked about inflation being transitory for so long, and now suddenly it's high, and why were we so slow to respond?
Yeah, I mean, I think that's a great question. I think that's the frustration that a lot of people have on their mind, because the current high inflation readings they're just unacceptable. And I think it's clear if the Fed would have had a crystal ball a couple of years ago and known exactly how things would have played out, that it would have conducted policy differently. And for example, President Kashkari, the president of the Minneapolis Fed, just had an essay a couple of weeks ago describing what he got wrong and why his thinking on policy has changed. So I recommend people look at that a little bit for one perspective on how the views shifted. The trouble is that there's uncertainty and unpredictability in policymaking. They're just unavoidable. And so when you're evaluating policy in hindsight, it's very different than conducting policy in real time. So here's why I think the Fed sort of got it wrong, but in real time, I think the steps that the Fed was taking were appropriate given the information we had. Throughout most of 2021, the vast majority of observers and market participants thought the increase in inflation was a temporary event. Joe showed you some pictures. The increases were concentrated in a very narrow range of pandemic-specific goods and services. Cars, the used car prices were going up. Hotels and airfares were bouncing back from lows. Furniture prices, lots of durable goods. So it was very narrow and very identifiable as pandemic-related price increases. So that led one to think that, once the pandemic plays through, supply chains will improve, that those temporary facts will mitigate. And raising interest rates in the face of temporary inflation increases would have slowed the recovery and cost jobs. So, keep in mind that as of September of last year, we were still 5 million jobs below the pre-COVID level. So 5 million people were still not working that had worked before. That feels like it's a long way from a maximum employment sort of measure. So employment's low and it looks like temporary inflation. But then the inflation dynamics changed later in 2022. And that's what Joe was alluding to. It surprised markets and the Fed. Price increases became more widespread and persistent. And it became clear that some of the supply chain issues would last longer than we expected. Labor supply is returning to the market, but it's not relieving the pressure on the wages that we hoped it would and on supply chains. And consumer demand has remained very strong despite the end of the fiscal support. So there were lots of fiscal stimulus came in 2021. When that rolled off, there was some feeling that should reduce demand, and demand has stayed strong for the durable goods that Joe was talking about. So you continue to see strong demand for durable goods with the supply chains, the combination of the demand and supply keep upward pressure going on those things. So, and then the real unfortunate on many dimensions recent development has been the further disruptions from the Ukraine invasion and the COVID flare-ups in China. So that has the possibility of disrupting things further. So this has all been a big shift and a bad shock that was an unfortunate timing on top of that has led us to our current position. So the Fed pivoted late last year and it's now moving aggressively. I think you're seeing that if you're watching the newspapers, you're seeing the coverage. You'll see a Fed speaker out there most every day talking about the commitment we have to price stability and making sure we're conducting policy and raising rates, providing the forward guidance so that we make sure we get back to price stability, and that's what the FOMC and the Fed is committed to doing. So I think that's what happened. It doesn't mean, we wish we could have seen it different. We wish we could have been in real time had a better forecast, but we didn't, and most people didn't. And I think that's the story of what happened. And now here we are. And the important thing is now going forward, we take the steps we need to maintain price stability, and we're committed. The Fed's committed to doing that.
And Terry, there was a question in the chat box about from a viewer who feels like the Fed's response to inflation feels a little bit more timid than the Fed's response to the pandemic writ large, and what's going on there. And maybe could you also elaborate, because there were some questions in the chat box just about that connection between fiscal policy and monetary policy.
Yeah. Okay. I mean, on the timidness of the response. I mean, I think late last year, we were just the tide started swinging on inflation, and we were watching the data come in, and we were monitoring. And as more data came in early this year, it became clear that wages were continuing to rise. Part of that's good news, right? Wages for low wage workers has risen, and so there are some upsides in this. But overall, wages are rising a lot. That's pushing a little bit on inflation, rising a lot. So that data just kept coming in. Now I'd argue the response looks pretty vigorous. It's true, there's only been one rate increase, as I showed you, but now there's multiple rate increases expected. And if you read the financial pages and you read, what people are expecting for the rest of the year, the FOMC itself has signaled rate increases steadily through the rest of the year, likely increases around the table for larger than 25 basis points, for 50 basis points. So I think now you're seeing a very regressive response. People wish if we'd have seen that coming a little bit earlier, we might have upped it a couple of months. But, I think the important thing is we're responding now. On the fiscal policy, monetary policy. Yeah, I mean, that's an important distinction for viewers to keep in mind. We're the Fed. We do monetary policy. We do not do fiscal policy. We do not do tax policy. So that's our lane. And the Treasury and the U.S. government, Congress, the elected officials, they conduct fiscal policy. And I saw in the chat box, there's lots of interest in the sources of inflation. Lots of discussions about how much fiscal policy may have contributed to the increase in inflation. And so that's an ongoing discussion within the academic circles. I think fundamentally the source of the shock has been the pandemic and the disruption in supply chains. You're seeing inflation rise in all countries across the world. It's up everywhere. So, I think that's the fundamental driver. Now, there's individual things happen. We had a strong policy response on fiscal stimulus. The idea was that helped a lot of people struggle who were, the people that were impacted by COVID tended to be low wage, less skilled workers who were more public facing and got hit harder by it. So, the idea was it was useful to help those people get through. One of the contrasts of one of the results of a big stimulus last year was it did bump up demand. And so there is a discussion about how much fiscal policy, may have added. And that's a debate that's going on right now. But I think fundamentally it's about the pandemic. It's about these supply chain services. The Fed just has to take fiscal policy as given. So that's something that the policymakers and the elected officials decide on. And then we conduct monetary policy to try to achieve the dual mandate that Congress gave us. So that's what's going on in that space.
And Terry, can you maybe elaborate just a little bit on the relationship between wage pressures and inflation and what impact that has?
Yeah, so that would historically be one of the channels by which we would see inflation pick up. So I think one of the concerns right now is wages are climbing at about a 5% rate. They've picked up more in the last quarter or two. The good news is it's higher for low wage workers, like I said, but wages pick up. That's a higher cost for businesses, and businesses are going to somehow need to recoup their cost for higher wages, and they pass that through. They have to build that into their price structure. In the olden days, there used to be more unions and union contracts, and so the union contracts would then start reflecting higher wages, and then the businesses would need to recoup the higher wages, and they would have to raise prices, and you get in this cycle of wage prices having to keep up with price increases. So I think that's the wage price spiral that people are concerned about. So far you can see by the long-term inflation expectations pictures I showed you that that's not expected to continue. There's two sides to this coin. I mean, part of it is low-wage workers in this country. We've wanted to see wage increases for a long time, and they're really the people that are seeing the highest wage increases. So, that is a positive aspect of what's happening. Is we are seeing, while it's frustrating for, I think, for a lot of people because it's hard to find the workers, you are seeing higher, especially low-wage workers, higher wages for these workers, and that's a good thing for their lives, for their opportunities, and all that. So, that's the concern, is that if we keep seeing high wages grow, that'll feed into inflation expectations. There's really no sign of that so far, but that's one of the things the Fed's keeping in mind while we try to adjust our tools to make sure, demand doesn't keep surging in a way that pushes wages higher and prices higher. So, we think it's going to be a temporary. It's 4 or 5% right now, depending on what productivity does. That's not so high. I mean, 5%, we saw that in 2000. So if productivity picks up, we're not sure what's happening there. That's part of what wage increases are. And then we just have to monitor that as we move forward. But that's the connection, that's the concern, and that's what we're watching for.
Let's go back to Joe here. Joe, you had made a brief comment about the money folks might have hidden under their mattresses. And we did have a number of folks in the chat box who are concerned about the low rate of interest that they're being paid right now on their savings, and how to invest in the future and when they're maybe going to see some increases there.
Yeah, well, that's one of the really, we're getting into kind of the costs of inflation and why we want price stability. That's one of the pernicious effects of inflation, is that for people who live on a fixed income, retirees, for example, or people who are low wage earners who haven't seen their wages increase, inflation erodes their real earning power and erodes their wealth. If you live off of savings and you're not getting a higher return on your savings, again, maybe because you're a retiree and you're not necessarily chasing a big return, you just want to protect your wealth. Inflation erodes the value of your wealth. One thing I can say as far as a bit of good news is the Fed's response, as Terry outlined, by increasing interest rates is going to lead to higher interest rates and higher returns for those living on a fixed income. And I should also point out that last year, the Social Security Administration did its annual cost of living increase and reflected the higher prices in that as well.
And Joe, another question for you. You had mentioned in your remarks, you talked a lot about the purchase of durable goods. And, how far can that continue to increase? At some point, folks don't need a new refrigerator every year, right? So what's the outlook on that?
So that's a really good question. And I'm actually gonna back that up and use it as an opportunity to put a plug in for some of the work that my colleagues and I do surveying businesses. So I've been telling a lot of the story of the last year or so, looking at the CPI and some of the other official inflation statistics. But one thing that we do at the Minneapolis Fed and then at the other reserve banks around the country as well is we do a lot of surveys to see how people are experiencing the economy. We're not all of our surveys are as rigorous as the surveys that they do at the Bureau of Labor Statistics, but we do a lot of surveys of businesses. And if I went back to even more than a year ago, even late 2020, when we started to see these real major disruptions in the supply chain, we started to hear from businesses that they were seeing acceleration in input costs a lot longer before we started to see it feed through to consumer prices. And that's, you can look at some of the various, actually just see a chart mention the producer price index. So you can look at some of the various measures of wholesale prices and see some of that earlier or input cost inflation reflected in those as well. But we started hearing about it from businesses. Now, what's interesting is over the last year, initially businesses were saying our input costs are really soaring for raw materials. A lot of them were actually complaining more about the difficulty in getting things at all versus paying for them. Transportation costs are much more expensive. But what we started to hear going into late last year, particularly from the manufacturers that I talked to and that we survey, was that their input prices had been soaring, but their customers were willing to bear those higher costs. The demand was so strong that they were able to pass on more of those costs to their customers, whether their customers were other businesses they're providing inputs to, or whether they were consumer goods. And so that kind of underscores for me, at least, the value of why we do some of this survey work, because we got kind of an early read on some of that sentiment. Again, if slightly less scientific than what they do at the Bureau of Labor Statistics. But as far as the outlook for consumer goods, again, what I've been hearing from businesses is they've been able to pass on along a lot of the input cost increases that they're seeing to their customers. In transportation, of course, they put in fuel surcharges into freight rates, and those have been there's still extremely strong demand for transportation, very long delivery times on a lot of raw materials. And so I think that's just kind of a reflection of kind of underlying strong demand, and we've seen that reflected in those durable goods purchases. I think a lot of earlier on during this recovery, there was an expectation that we would kind of see durable goods purchases slow down as people started buying more services again, started going to the hair salon. They would start spending a little bit less money on appliances and other big ticket items, but they're still holding up pretty well.
Thanks. There were also a couple of questions in the chat box, and this maybe is for Terry or maybe Joe, about the inversion of the yield curve. Can someone tell us what that means and why that's important?
Yeah, I can jump in on that one. So the yield curve is a chart that shows you what Treasury rates are from 3 months, 6 months, all the way out to 30 years. So you see the yield on each of these Treasury rates, and in normal times you expect, if you buy a Treasury for 10 years, that should have a higher interest rate than if you put in for 3 months. So that's called an upward sloping yield curve. That's what it looks like when the economy's performing well and in times when there's not trouble. It's upward sloping. One of the historical facts is that yield curve flattens. It tends to flatten. It's just sort of a statistical thing that the short rates come up and the long-term rates don't come up. And you'll see it in inversion is when the longer rates are actually lower than the shorter rates. And if you look at charts, it's pretty striking that when you see an inversion of the yield curve, there tends to be a recession in the next 1 to 3 years. And so that's a pretty striking correlation. That leads people to look at the yield curve. And right now, especially from 2 years on out, it's pretty flat. So that's raised concern about the flattening of the yield curve. A couple things to say about that is that's a correlation. It's not a causation. So the yield curve did invert in 2019. It's hard to say the COVID recession was due to an inversion of the yield curve. They seem unrelated. So sometimes there's things like that. But there is information in the shape of the yield curve. It does tell us something about the neutral rate of policy, where we think the policy rate is going to settle in the long run. And in insights in the discussion, it's about how high does the federal funds rate need to go, and the yield curve kind of helps provide some information on that. I would just add that recent work from economists at the Fed, at the board, has found that most of the predictive information is contained in the short end of the yield curve. So they find it's actually the current rate and then a forward rate 18 months from now. So very short end of the yield curve, and that remains positive. So that part is not really, that's upward sloping and not really showing any signs of a recession. So that's a little bit comforting, in that measure is still showing it. So this is a very different time. This recession and this COVID and all the response to it. It's hard to say that the historical pattern is a rock solid, reliable prediction. One thing's sure is that the Fed is going to do what it can to try to bring inflation down smoothly and keep labor market strong. That's the dual mandate.
Thank you, Terry. Thank you, Joe. That is all the time that we've got for today for questions. I know we had a number of them in the chat box we weren't able to answer today, but we appreciate your participation today. We will be sending a follow-up email to everyone who registered for this event with a copy of Terry and Joe's slides, as well as a copy of this video link. We'll also send you a pop-up survey. You'll get that as the Zoom window closes, so you can give us a little bit more about what you liked about this event and what other questions you have about inflation. And you can attend our next virtual event, which is also based on inflation. It's coming up next week. It's with Fed Governor Lael Brainerd on April 5th. And I put some registration information for that in the chat box on Zoom. Thank you so much for joining us, everyone. Have a great day.